In this lecture, we'll cover the CFA Level 2 reading on dividends and share repurchases. And this reading is an extension of a reading with a similar name that you saw at Level 1. So here is what we'll look at, but I'll summarize the main point of this reading. In the earlier reading, we looked at whether the capital structure, the ratio of debt to equity, impacts the value of a firm. In this particular reading, we will look at whether the dividend policy, so how much of a company's earnings are paid out as dividends, whether dividend payouts and dividend policy impact the value of a company, right? So we will look at some theory, and then we'll also look at some practical considerations. Section 2 deals mostly with theories, and the interesting aspect of the theories that we look at is that different theories say completely different things. There'll be one theory which says that dividend policy does not matter. There will be one theory that says that if you pay more dividends, that increases value. And there'll be another theory that says that if you increase dividends, that reduces value. And then you have to look at the context in which you are operating to figure out which theory applies in your environment. So let's start with section 2.1. Here we'll talk about the theory which essentially says that dividend policy does not matter. In other words, whether a company pays dividends or does not pay dividends, that does not impact the value of a firm. And interestingly, the same people who talked about capital structure irrelevance are also the proponents of dividend irrelevance, Modigliani and Miller. So Modigliani and Miller's dividend irrelevance theory says that assuming perfect capital markets, and again this is a big assumption, where we don't have taxes, no transaction costs, and we have symmetric information, so the outside investors know all the same things that the insiders know, then dividend policy does not matter. An implication of this statement is that dividend decisions are independent of investment and financing decisions. There is no meaningful distinction in this theory between dividends and share repurchases, because what is being said here is that these are both ways of a company to just give cash back to shareholders. From an investor perspective, the reason dividends don't matter, according to this theory, is that investors can always generate homemade dividends. In other words, if a company is not paying dividends, then if I need money, I can just sell some shares and get money. That would be like getting a dividend. What if a company is paying dividends and I do not want dividends? Then I can use the dividend that I get to buy more shares. So that is the basic intuition behind the theory that dividends don't matter. Investors can either create their own dividends, or if investors get dividends, they can just buy shares. Then sections 2.2 and 2.3 say that dividend policy does matter. And there are two aspects over here. The first is the bird in the hand argument. And this is the old proverb that a bird in hand is better than two in the bush. What is the bird in hand? This is the dividend. So according to this theory, investors actually prefer the dividend because you have that money, as opposed to retained earnings. Retained earnings stay with the company. With retained earnings, there is a promise that the company will keep that money and then invest that money in high return projects. But that is the promise of two birds later. And the value of you having money, according to this theory, is more. Investors view cash dividends as less risky and hence preferable over retained earnings. If the cash that you get in the form of dividend is less risky, then when you value a company, according to this theory, you will value at a lower cost of equity. Remember the dividend discount model? So you project your dividend payments. According to this theory, you will discount at a lower discount rate, lower cost of equity, which will produce a higher present value. But Modigliani and Miller gave a counter argument to this, which is that, look, the discount rate really should not be based on just the dividends. The discount rate should consider the actual riskiness of the future cash flow generated by the company. So here is a theory, and then Modigliani and Miller poke a hole in the theory. The other argument, which is somewhat stronger, is the tax argument. In most countries, the tax on capital gain tends to be less than the tax on dividends. So if this is indeed the case, then would you as an investor prefer $1 in capital gains or $1 in dividends? The answer is that you would prefer $1 in capital gains because you are paying less taxes, which would mean that all else equal, according to the tax argument, if there is this difference between the tax rates, then the company that pays less dividend will be worth more. So that is the point. Lower dividend payout will result in a higher stock price according to the tax argument. Let's go over some other theoretical issues and then we look at some interesting questions. You need to understand something called the clientele effect. Groups of investors are attracted by a particular dividend policy. For example, old retired people will generally prefer companies or stocks that pay a dividend. Young professionals who have a good salary might not be that concerned about dividend. They would prefer stocks where the capital gain potential is higher. So what I have outlined here or described here is two different groups of investors, and a group of investor or groups of investors are being referred to as clientele. So now if we do recognize that there are different groups of investors with different preferences when it comes to dividends, some would like dividends, others don't like dividends, do you think this impacts the value of a company? The answer is probably not. Why? Because there will be different companies with different policies, and different investors will go buy shares in companies where the dividend policy suits them. So the market will itself sort out. Just because there is a clientele effect doesn't in of itself mean that there is an impact on the value of a firm. But the clientele impact does promote the stability of dividend policy. So if you have a given company which has been giving dividends for a long time, and obviously the investors then will be those investors who like to get a dividend, it would be very awkward if this company suddenly changes its dividend policy. So because of the clientele effect, there tends to be stability in dividend policy. Another important aspect is the impact of tax rates. If the tax rates applied to dividends and capital gains are the same, then all else being equal, the expected price drop when a share goes ex-dividend is the amount of the dividend. So this is just a basic point, that let's say that the tax is 30%, and simplistically put, if you have a price, and I'm going to just explain all these subscripts, PW stands for the price of the share when it is trading with the dividend, and PX stands for the price of the share when it goes X, which means that it is now trading without the dividend. Assuming that the tax rate on dividend income is equal to the tax rate on capital gains, assuming those two rates are the same, then the amount by which the price will change when the stock goes X is approximately equal to the value of the dividend. So is this a simple relationship to remember? I hope so. You need to know this. But what if we take the more realistic scenario that the two taxes are different? The tax rate on dividends is not the same as the tax rate on capital gains. Then the curriculum works through an explanation. It gives you the derivation, which you can look at if you are interested. But I want you to memorize this relationship, and I'll give you an intuitive explanation here. when the dividend is paid, the price clearly goes down. Price with dividend minus price ex dividend or without dividend, that differential is equal to the dividend amount into 1 minus TD, which is the tax rate on dividends, divided by 1 minus tax on capital gains. Now, how do you remember this? You can start with this basic relationship where the difference is equal to D. Notice what happens if the two tax rates are equal. Then the numerator and denominator are equal and you simply have the difference is equal to D. Okay, now generally the tax rate on capital gains tends to be lower than the tax rate on dividends. So simplistically put, that would mean that people would prefer that the company not pay dividend, if this is indeed the case. Now, if you take a situation where the tax rate on dividends is 0.5 or 50%, and the tax rate on capital gains is equal to, let's say, 0, just as an example, then what is the change in price going to be when a company pays dividends? It's going to be D into 0.5 divided by 1. So the change in price will be half of D, just as an illustration. And now we are also going to look at some examples. There is one more point that I just want to highlight here, other than remembering this relationship. The importance of this particular ratio, 1 minus TD over 1 minus T capital gains. So this ratio can be viewed as establishing an indifference relationship between dividends and capital gains. So if this ratio is equal to 0.5, what that means is that you are indifferent between $1 in dividends versus $0.5 in capital gains. And you see where that is coming from. That is coming because of the different tax rates. Now let's see whether you have really understood this. And again, I will emphasize, just before I go to the next slide, remember this relationship over here. Learn it. Now we are going to work through several little questions in example 1. So try this first. So here is what you do. With dividends, you get $1 but pay 28%, so you end up with 0.72. With capital gains, you get 0.87, pay 15% and end up with 0.74. So clearly 0.87 in capital gains is better than $1 in dividend. Next one. So try this now. This with you. So this is an interesting question. I'll work the numbers with you, and then there is some terminology that I'll also go over, such as marginal tax rate and so on. The first important piece of information is that the share drops by 70% of the amount of the dividend when the share goes ex-dividend. So what that is saying is that the change in price divided by the dividend, so change in price over dividend is 70% or 0.7. And based on the relationship that I asked you to memorize on the previous slide, we can say that the change in price relative to the dividend is equal to 1 minus tax rate of dividend divided by 1 minus tax rate on capital gains. So if you plug in the numbers, 0.7 is equal to this ratio, and you are given that capital gains tax rate is 20%, then you have this equation with one unknown, which is the tax rate on dividends. So you can calculate that tax rate, which is 0.44. Now let's look at terminology here that you might not understand. The marginal tax rate on dividend income applying to those who trade the issue around ex-dividend day. So there are two important concepts here. One is that with all these rates, we are talking about the marginal tax rate, which means that the tax rate that is being paid on an additional dollar of income. So that's what the marginal means. And also all these relationships are based on the tax rates of the people who are actually trading. You can't just look at the average tax rate of all people in a country. That doesn't matter. What matters over here, these tax rates are the tax rates of people who are trading. So that is the point over here. Not everybody has the same tax rate. Obviously, the dividend tax rate typically is the same as the income tax rate. Not everybody has the same income tax rate. And when we do calculate TD, then the question is whose rate are we calculating? And the answer is we are calculating the rate of the people who are actually trading. So that is the point over here. And what have you been able to do through this information? Given the drop in price, given that that drop is 70% of the dividend, you can use these formulas to determine the tax rate of the people who are trading, in case you were ever interested in figuring that out. Okay, next, here is another tricky one. This is a slightly tough question and I'll just explain it. We are told that the tax rate on dividend and the tax rate on capital gains is 40%. But the difference is this. Let's say you are the company. When you get $1 in dividend, we are told that only 30% of that $1 is taxable. So when you get $1, the taxable amount is 30 cents. The tax rate on that 30 cents is 40%. So effectively, the tax that you pay on $1 dividend is 0.12. So we can say the tax rate on dividend is 12%. With the capital gain, the entire $1 is taxed. So there the tax rate is 40%. Now the question is, what is $1 of dividend worth in terms of capital gains? So actually $1 based on this discussion is more valuable than $1 in capital gains. So $1 of dividend is more valuable. Now if you remember our relationship, we said that $1 in dividend is the same as this particular ratio. That ratio was 1 minus TD over 1 minus capital gain. So when you do this ratio, what do you have? So you have 1 minus 0.12, which is TD, over 1 minus 0.4, which is going to give us 1.47. Bottom line then is $1 in dividend is like getting $1.47 in capital gains. Now this situation is the opposite of what we would expect with an individual. With an individual, you would generally be happier with capital gains because the taxes there are lower. But this question illustrates that in a corporate context where some of the dividends are tax deductible, then you actually prefer dividends over capital gains. There are a few more questions here which I would want you to do, but we have done the most difficult ones, and if you've understood the concept, then you can work through the remaining questions and then you can look at the solutions in the curriculum. Here is another straightforward example: clienteles and preferences for dividends versus capital gains. Suppose it's established that about 70% of investors prefer a relatively high income stream from a given size position in shares. So is this one particular kind of clientele? It is. You are on the board of directors of a company with a dividend policy that specifies a particularly low dividend payout ratio. Give two reasons why having your company adopt a higher payout ratio may not lead to an increase in shareholder wealth. So you think about it. These are one of those questions where the example is set up to highlight some important theoretical aspect. So the solution is, first, even if the dividend payout ratio is not increased, individual shareholders may be able to manufacture their desired income by selling shares as needed. So we talked about this in the Modigliani and Miller dividend irrelevance theory. So the homemade dividends can be created. Second, if they are tax clienteles, by adopting a higher dividend payout ratio, the company may be merely changing one clientele for a different clientele. That will not change the value of a company. It's just that you now have a different set of investors who are buying your shares. Signaling content of dividends. As you know, with any company, large company, we'll have information asymmetry. Managers and insiders know more than outsiders. So the board and management may use dividends to signal to investors how the company is really performing. Okay, because what investors will look at is what the managers do, much more so than what the managers say. Right? So based on empirical evidence, when a company that has not been paying dividends starts paying dividends, so that's called a dividend initiation, or the company increases dividends, then generally that is viewed as a positive sign. Why? Because investors say that if a company is increasing dividends, it is doing so because the company expects to make substantial cash flow in the future. It would be very silly for a company to increase dividends if the future outlook is bleak. And investors know that. Investors know that a company will only be raising dividends if it can actually maintain those higher dividends. So that is why often when companies announce higher dividends, that is taken as a positive signal about essentially that the future prospects look good, and often you will see the stock price go up a little when there is an announcement that the dividend has increased. If the company increases dividends but then cannot sustain, then the stock will take a hit. Similarly, if a company reduces dividends or stops paying dividends, then that is generally viewed as a negative signal. And I say generally because this is not a hard rule. Under certain circumstances, if investors are convinced that a company is not paying dividends because it has some excellent investment opportunities, then the stock price might actually go up. So you as an investor need to understand why the dividend policy has changed. Here is an example that I will want you to read, and the simple point here is that just because a company wants to raise its share price, and even if its future prospect is not good, but to raise share price, it announces that it will increase earnings or it will increase dividends. Is that a good idea? Probably not, because maybe in the short run the stock price will go up, but if future cash flow is not good and dividends cannot be maintained, then as we just discussed, the stock will take a major hit. So you can read this and then also look through the solutions. Agency costs and dividends. Agency costs can be high at relatively large organizations. One risk is that management might invest in negative NPV projects. Such risks can be partially controlled through high dividend payouts. So what's the point here? Generally, company managers get paid more if the company becomes bigger. So there is an incentive sometimes for management to take on large projects, even if the projects are negative NPV projects. Is there a conflict here between management and owners? There obviously is. So one way for this risk to be partially controlled is for the owners to say that the management or the company needs to pay out as much dividend as possible. If dividends are paid out, then the probability of money being invested in low NPV projects or negative NPV projects becomes much less. Another related factor has to do with the corporate governance of a company. If the corporate governance is strong, then you would be comfortable with a lower dividend payout. On the other hand, if the corporate governance is weak, then you would want the company to pay out more dividend so that there is less opportunity to misuse the company cash. Now see if you can do this question. This, by the way, is example 5 from the curriculum. So quite a lot is stated here, but here is the summary. Two companies, A and B, both are generating good cash flow. Corporate governance at A is good. Corporate governance at B is not so good. Plus the profitable opportunities at B are also down. So if you are an investor in both companies, you would want B to start paying you more dividend, because if the profitable opportunities are low and corporate governance is not good, you definitely don't want management sitting on a lot of money. When management has a lot of money, they might overinvest. Overinvest in this context means investing in negative NPV projects, maybe doing some empire building, just trying to become bigger so that salaries increase. You would not want that. So the best answer is B. Mitigate potential underinvestment problems. That's not an issue here, because in any case the company is generating a lot of cash. So the best answer is B. Another related point is that paying dividends can exacerbate the agency conflict between shareholders and bondholders. Normally we talk about an agency problem between managers and shareholders, but there is also a conflict between shareholders and bondholders. What's that conflict? Shareholders want high dividends. Are bondholders comfortable with shareholders getting high dividends? The answer is no, because if high dividends are being paid, then the chances of bondholders being paid becomes less. And that's why you might recall from fixed income that bond indentures sometimes demand that in the indentures there are covenants that might restrict dividend payments in order to protect bondholders. So this is a quick summary of section 2, and there isn't much here, nothing new. I would just have you read this little excerpt from the curriculum.